Hey, future families. This is Carmen Hope Thomas.
And Jason Thomas.
And we're from Future Family Finance, and we are spreading the message. Last time we did a video like this, we had thousands of you email, call, text, like our page, and we want to continue to drop knowledge about money. So before, I had my husband, Jason, to share some information about how mortgages work. Well, that went over very, very well, and this time I want him to do something else in the same vein but a little differently, how credit cards work. Because when I first got married, I had a lot of credit card debt, and he helped me with my credit card debt. And this little trick that we're going to share with you right now is going to be something that you can apply. And being that this is a video, you can always rewind back because it is a little bit of a concept that's going to take you a bit to understand and to grab a hold of.
So what we're going to tackle today is dealing with if you know that your budget is tight, and for many of you, you can only afford to make the minimum payments on your credit cards. And you know that in doing so, it doesn't do anything to really help the situation. You're just treading water at the moment.
Right.
But we're going to show you how even making a minimum payment on a credit card, you can still pay down the debt even faster than the way that you're doing it.
Exactly, and it really starts with understanding how the credit card companies are making money. Once you understand how they're making money, you can decide whether you want to give them your money.
So real quick plug. First of all, many of you watched the last video. I want to give a quick shout out to the Howard family in Honolulu, Hawaii, who are current clients of ours. They have been in the mortgage for 2 years. They've gone from a 30-year mortgage down to now paying it off in 11.5 years, saving close to $100,000 of interest. This is without them ever having to refinance. Their monthly payments still remain the same.
And their budget.
Their budget does not have to change in order to do that. So what we're going to do real quick in this scenario here is look at the situation of just making minimum payments and how that actually works. So let's get this set up.
This is juicy, y'all, so pay attention.
Oh, this is going to be fun. Let me get this set up here, and we are going to get the slideshow ready. All right, so right now, many of you should be looking at our screen with our company, Future Family Finance, and let's go into the scenario here. So here we have a calculator on the screen showing $3,000 debt. So this is your current credit card that you have, and I'm breaking down how it actually works. You have a 20% interest rate, as you can clearly see here. The monthly payment is $50.96, which is the minimum payment, and this is based, all credit cards are amortized over 240 payments, which equates to 20 years.
And that's important to know because even for you students out there with $500 limits, they have amortized it over 20 years. That's important to know. So
in looking at this, we can clearly see, as I just quickly grab a quick spotlight here, the interest on this over that period is just over $9,000. The total that we will be repaying back is over $12,000. And the percentage of principal, the total interest paid, as you can clearly see, is well over 300%. So that's what we're actually looking at. So let's actually break this down so we can clearly see how this actually works. So now we all agree that we're making a $50.96 payment every month because this is all we can afford to pay. And when we look at the amortization schedule here, this is payment number 1 for the first month. Say that we're doing this in the month of January to get started. Only 96 cents of that goes towards the principal. This is what we get the credit for. The $50 is the bank's fee, or what they call the interest. So if we jump all the way over here to the principal balance, it will reflect the 96 cents credit that we get to that. So this is what we currently owe. Now, let's look 6 months down the road. In 6 months, we would have only applied $6 roughly towards the principal. And look at how much it would have cost us, roughly $300, right?
That's important for you to keep in mind. Remember, after 6 months of paying on your credit card, $6 has gone towards the principal, and $300 has gone towards interest.
So the concept that we want to teach is a concept called interest cancellation. How can we go about canceling the interest on the debt? So the interest here is $299. $75. You really would love to have the situation reversed, where you have more. This money's going towards the principal, and this is what we're paying in interest. But that's not necessarily the situation for most of us if we're just making the minimum payment. So how can we still make the minimum payment but get a better bang for our money at the end of the day? So let's understand what actually happens. We get our income. In this case, we show an example of you getting paid, let's say $750 a week, which accumulates to $3,000 for the month.
Now, this is important because I tried to explain this to a friend, and I really couldn't get him to understand. He and his wife thought I was crazy when I tried to bring this up. But please listen closely, because this is a really neat trick.
So that money is deposited into the checking account. The only reason we have it there is because we need a place to park our funds so we can turn around and pay our bills. We agree the bank is not a place that we utilize for investment purposes. So it serves a singular purpose.
Just to pay the bills.
Have access to pay the bills.
That's it.
So with that being said, when we look at another situation here are just a handful of some of the expenses that we typically have throughout the course of a month. We have fuel that we have to pay for, filling up the car, grocery bill, cable bill, and tithe. I'm only highlighting a few of them. I know you all have many more, some of you do. When you add all these numbers together, it comes up to about $1,000 a month. I'm highlighting these because from the cable and the tithe and the groceries and the fuel, we can all agree, those we typically pay with a debit card, right?
Absolutely.
We go and get the debit card swiped, and we use it. Even the tithe.
Yep, our church takes a debit card.
That's exactly correct. So you can do it that way as well. Now, can we all agree? Any of these institutions that take debit cards can also take credit cards. We can all agree on that, correct?
Absolutely.
All right. Now, I'm going to show you the value of using your credit card as opposed to your debit card. Because remember, we only need a place to park our funds so we can pay our bills.
Absolutely.
So we could take the $1,000 that we get paid in the course of the month, take the same $1,000 and park it or deposit on the credit card for future payment. We all agree on that because we'll leave the money sitting in the checking account
and
that we can nickel and dime, eat off of that to pay those expenses.
But by putting it on your credit card, we're going to show you the benefit of that.
So let's do that. We're going to take $1,000 that we would normally leave and eat off that throughout the course of the month, and we're going to, in this case, park it on the credit card. Now, as far as the credit card company says, for you it's just a deposit so you can make your payments on your expenses. For the credit card company, they say thank you for the payment, right?
That's
so
right.
Now you owe $2,000 on that credit card. We're using the same calculations we were using before at 20% interest. We're still amortized over the same period of time, but here's what gets very interesting. Now let's look at how this allocation actually works. So let's put a spotlight on this real quick so that we can actually see what's actually happening here. Move this out the way. Now, when we focus on payment number one, still making the same $50.96, but watch what happens here. What's going towards the principal now was $17.63.
Same $50.96, but 33 of it, 33 is going towards interest.
That's exactly correct. Because what's happening, remember, we're parking that money there. Now, we know that, well, let's understand this. Credit cards are calculated by the daily average balance. So for every day that this money sits on the card,
you're paying less.
It's reducing the amount of interest that we actually have to pay.
Because I can hear, because my friends, when I tried to explain this to them, they said, well, Carmen, I still need the money. I still have to pay my bills. I can't put it on my credit card because I have to pay the bills. Well, I understand that, but this is why this works.
So let's look at the calculator on the screen. $50 divided by 30 months. We agree it's $1.66 in interest that we're being charged every day, correct?
Every single day.
Now, what we're simply looking to do is reduce that interest cost. So for every day that we allow that money to sit on the credit card that is not being used now, can we agree it's reducing the amount of interest that the bank can charge us?
That's right.
Do we still have access to the money to pay the bill?
Absolutely.
It hasn't gone anywhere, but now we're serving a dual purpose. We have access to the money to pay the bills, but now until we need it, it can sit against the debt, reducing the amount of interest that the bank can charge us. So look what happens now in 6 months. In 6 months now.
If you did this for 6 months,
that's right.
Instead of having $6 go towards your principal, you'll have $110.
And roughly $200 going towards the interest.
It's not that you've done anything magical, and I know some people say, well, that's just $100. But let me tell you something. When you don't have any money, when you are already begging everybody and borrowing from everybody to pay everybody, that a little bit of money makes a big difference. And if you look at after 2 years of doing this, you're in a position, and you can look at it on the screen, where you're starting to pay more towards your principal than you are towards your interest. That green line there shows that tipping point where now you're paying actually more towards the principal than you are towards the interest with the same budget, with the same $50.
So let's summarize this real quick. By taking whatever bills that you can pay with the credit card, by leaving that money sitting on the credit card until you actually need it.
You reduce
the amount of interest, so that when you make your same $50 payment, just for the minimum payment, we can all agree now more of it now is going towards the principal, simply because we're canceling interest. That's the concept of what we call interest cancellation. And all this culminates really from the technology that we use. Mm-hmm. You've heard us mention before on these videos that we have a computer app. Mm-hmm. That what's built into it are these mechanisms that we're talking about of interest cancellation, of how much money to move and when to move it. We just simply pour all of our debts into the app, and it tells us how much money to move and when to move it, precisely on what day to do it and the amount to do it in order to cancel the most amount of interest. This is why now you're in a position where you can, by making your money smarter, without having to get another job, without having to do other activities as well, you can now have the ability to pay down your debts a whole lot faster. I hope this information was useful to you all.
I hope so too. And I hope my friends who were here at the house, and I was trying to explain this to, I hope you hear this. So now it makes a little bit more sense.
If you have any further questions, get back to us. You can inbox us. You've got in the comment section here, you have
and like our website page, like our YouTube page, as well as our Facebook page. We'd really appreciate that. And you can follow us on Twitter.
All right. Thank you, guys.
See ya. Bye.